All right. Okay. Good afternoon, everybody. Welcome to live valuation. Just give me a moment. Make sure everything is up and running. Doing stuff a little bit differently today. Obviously, we're at a different time today, but that's kind of just because I've been very busy. I did stream on Friday. Streaming late today. Might not do all my normal streams this week in general. I'm in the middle of preparing to move in about a week. That's going to be a very, very busy week in general. So I will be completely not streaming next week, possibly longer, depending on how the move goes. But this week as well, I'm going to be streaming, who knows, maybe 3 times a week like normal, but maybe not. Hard to tell. But anyway, trying out a whole bunch of different settings as far as all my setup goes. So give me a second to see if everything's in place. But we're going to do at least a brief stream today. Looking at Skyworks Solutions. Semiconductor and RF chip manufacturer. One of the major manufacturers for Apple, amongst many other companies, but Apple's their major customer. So we're going to take a look at them. We provide a whole bunch of products for a whole bunch of different applications outside of just Apple, but that is their biggest customer for sure. They're one of the companies I actually have a previous valuation for, so we're just going to be copy pasting, filling in the blanks, and then kind of updating it from the old spreadsheet template from some time ago. But as I said, give me a moment. Make sure it's up and running. Yeah, hopefully this won't take a super long period of time because I have other things I've got to get to today, but I figured at least I have enough time to perhaps update this one. Kind of want to look at some other things and show. I had my watch list spreadsheet that I was playing with. I think the last time I showed it was like over a month ago because I decided there was major issues with it and have been kind of working to update it, which I did. So I kind of want to show off that too, but we'll do that after I'm done with this when I put the information in. Second. Yeah, I finally pulled out a third screen for my setup so that I can actually hopefully see comments in chat as they actually happen rather than noticing them like an hour later, which is kind of how it's been. So we do have that, slightly different, but kind of just experimenting with the setup because like I said, I'm moving, so I have to kind of redo my entire setup once I get there, get moved in. Need to buy a new desk when I get there that can hopefully be well situated for everything. Hold on. just checking to see what work I'd done, because the last time I valued Skyworks was right after their fiscal year ended, which is in October actually. So a little bit. Not actually hasn't been that long, essentially. I'm saying, but it was with my old template, so I still want to update it, even though we've only had 2 quarters since the last one. But all right, so start copying, pasting everything. Wrong line. Yeah, this should hopefully not take too long. I actually thought it was going to take longer because I didn't realize that I actually had done the fiscal year 2020. I thought I still had a, like I thought I did it after the 3rd quarter, so I thought I was going to have a trailing 12-month figure in the old spreadsheet that I would have to fill in with the actual fiscal year and then do these last 2 quarters. But I actually do have the fiscal 20, so I can just put this in, do the trailing 12 months. And what that does mean is that also the numbers as far as the revenue distribution geographically, as well as other information, hasn't changed. I just have to update the numbers that go into that from my data source. Update the equity risk premium numbers themselves, as well as the beta figure numbers. Although I'm granted, they have a relatively simple segment setup. It's just semiconductor. You know, I don't have to. It's not like they have like 3 or 4 different businesses or anything. So that'll take like 3 seconds. But it means their debt major numbers haven't changed either. Granted, they don't really have debt. It's just their lease debt, nothing else. If they have lease, I can't actually even remember if they did. But yeah, so this shouldn't take too long. But I am gonna copy paste the quarterly numbers into the other page and then just add it up within, sort of like how I've done for the last few valuations. So should be faster. And the net debt issuance, bring it. All right, 713 million. That's what I have on the other spreadsheet, so that seems to be pasted over correctly. put dividends on here. That's all I do. So we're just $2. Loss is 5106.7. Okay, yep. Make sure I copy that over correctly. Everyone who watched this had a good 4th of July. I know I did. Okay. All right, let's do equity section, and then we can move on. Okay, and all the older financial statements have been copied in. The for its pretty basic segment. You have the one semiconductor segment. I mean, I'm pretty sure in their 10K they actually do split up into like 2 separate sections, but they're both just semiconductors, so we're really just gonna call it what it is. It's simple enough, and then we can put the industrial average for that in. Unlevered beta went up a little bit for them. Sales to capital ratio for their industrial grouping went up as well. After tax, lease, and R&D adjusted margins, that actually came down a little bit. Okay, apparently I need 30 lines in here. Insert 3 lines. Good. Paste. Now we're going to have to change it up a little bit. It's like South Korea, Taiwan, other Asia, China, US, those are all fine, but kind of being a little bit of a basic bitch and waiting Western Europe, Eastern Europe, Middle East, and Africa all the same, which is not going to be kosher at all. As I've kind of showed in other evaluations, I try to kind of do a rough estimation of weighting by GDP, so that you're not overweighting the higher equity risk premium continents. Western Europe makes up 21% of the GDP of the world, while Middle East makes up about 4.5%. Eastern Europe makes up almost 6%, and Africa makes up 2.37%. So I mean, those last three I'm not gonna do super precise weighting for. I'm just gonna weight Africa, Middle East, Eastern Europe the same, and just call them one each, which is sort of what we already have here. But we are going to weight in a whole lot more of Western Europe. Be roughly twice as much as the other three combined. So we're going to weight in 2 extra lines of Western Europe. Just to get it roughly in the right ballpark. And the production is not singled out that way at all, so we can kind of ignore that. But then sure that we actually have the right premiums. Doesn't look like it. China. 5.4. Do South Korea and Taiwan since I'm already looking at the Asia grouping. South Korea is 5.2. 1. 5.31. And then Asia as a whole, 5.75. All right, do those other continents. Africa is 9.64. Middle East 6.25. Eastern Europe is 6.8. And Western Europe is 5.56. Okay, now doing the production, 4.72 for the US. Global is 5.76. Singapore, I assume, is still default free, which make them 4.72. Go back up to the Asia grouping. Yeah, Singapore hasn't changed. Japan 5.4. And let's go find Mexico. $6.27. Okay. So the revenue equity risk premium comes to 5.02. The production risk premium comes to 5.46. We're going to weight them half and half. And then I need to correct the formula here. Is their total average country risk premium to 5.24. Let's check to see if I need to update my base equity risk premium. I have a feeling that they didn't put out a document today since today is the observed holiday, but we'll find out. Maybe they did. Maybe they'll put it out tomorrow or skip a week. Yeah, it's not out. So okay, so after adjusting for the current mature equity risk premium with the ratio, we come to 5.29 for their equity risk premium. Unlevered weighted beta of 1.22. We still need to figure out a bunch of other numbers to see what their total levered beta is going to come out to. That does it for the country risk premium. Back to the old spreadsheet. They have no debt, but they do have, I'm pretty sure this isn't debt. I'm pretty sure this is just a lease. About to put in. I'm not sure what I'm doing there. I didn't need to do that. No need to hit it. I can just copy that in and do it. Maybe not. Okay. Okay, so that's all of the information from the old spreadsheet. I'm pretty sure I'm going to need, but we'll just leave it out in case I change my mind on that. Their most recent 10Q came out April 2nd. In there, the shares that they have outstanding at that time, 165 million. See if we can find anything about RSUs. Or weighted options, either one. Don't see it in the queue. I'll look for it in the 10K. questions. Wait a minute. All right, all right. There's the RSUs. .9. Back down at the lease liabilities. I see it put in the average discount rate correctly and the weighted term correctly, but I actually didn't put correct number here. Put it net of the interest payments, but I'm supposed to put the book amount, so that should be the correct amount. Not a huge difference, but important nonetheless. Okay. Got those ends all worked out. Let's this. What? Why it's doing that? Hold on. Come on, what are you doing? Alright, it's using to paste in table form. There we go. Okay. This got the 6-month ending period. All right, so it's gonna be this 2020 revenues minus previous period revenues. Probably they're all lined up. I'll do that. These revenues plus these revenues. Very large jump in revenues. 6-month period. Hold on. Hopefully this isn't. That is. Hold on. Push that off. Able to here roll over. All right, now the cost of revenues 2020 minus 6-month period previous, current 6-month. What? Did I do it right? Hold on. Like highlighted. Double check all this. $17.42, 900, 22, 23. Okay, never mind. It's doing it right. The merge cells just really throw me off. I don't really want to take the time to unmerge all these cells. So. All right, DNA. This organization, restructuring, impairment. So we'll include that. None of it here's it. R&D. It's the 6-month period. Recent 6 months. They did increase their R&D, but not nearly as much as their sales. Same with their SG&A and the amortization that they actually list in the financial statement. Do that as well. Did that wrong. What am I doing? What are you doing, Derek? Here we go. All right, so pretty significant jump in reported operating income, primarily on the back of the revenue growth, pretty consistently upward. They did increase their cost of sales in scale with the revenue growth, but their overall operating expenses were pretty minor jumps relative to it. So that's really good. That's really good scaling. So you have income listed, operating income. So they have other income net. So that's no. Because we're gonna have to list the interest rate as the book interest rate for their operating leases. No, no, no. This minus that. Overall, their income before taxes jumped pretty dramatically still. Then we have the actual taxes, the previous year minus 6 month prior plus the current 6 month, which did jump pretty dramatically. Makes sense, made much more profitable, so the profit jumped, but it jumped relatively low relative to the revenue growth overall still. Like this, it doubled in the year period, but it was also down from 2019. So rolling 3 years kind of been coming downward. The average between three separate 3-year periods comes to 16-17%. Have any other things? Was that it? Pretty sure that was it. Yeah. Okay. Diluted average shares outstanding. Six-month period, that's what this is, but that doesn't include the 6 month prior. So we're actually going to average out the 2020 average plus the 6 month to sort of estimate what the trailing 12-month diluted share outstanding count is. Kind of a rough estimate. Right. So the reported net income for the trailing 12 months is a little over 1.2 billion. It actually comes out to closer to 1.5 billion after adjusting for amortized R&D. So not too shabby at all. Pay no attention to that. We have a lot of things to do. Margins, for example, is not anywhere near what we're going to probably place it at. All right. Cash flow. Thing. 2020 minus previous 6 month station. Down a little bit. Selective non-cash adjustments. Do we actually have any that we're gonna do? No. Leave that as change of working capital. Effect on cash flow. Building up their working capital, but not quite as much. CapEx. It's negative cash flow, so I have to reverse the sign to make sure it's in the correct placing. Increased their capital expenditures by 22.5% compared to the roughly 30% jump in income, so they were building out some capital beyond just the working capital. So between building up the working capital and the capital expenditures, that's actually all capital expenditure essentially. And combining that also with the R&D. Well, after amortization, after the capitalizing and amortization effect of it, we're making the actual realized R&D expense be 223. But then the total of it on the capital end of it would be whatever's left of that. Would be the actual R&D expense that they listed minus the amortization expense that we use. So it'd be like another 200 or so. So yeah, pretty good overall growth in capital spending. After you net out everything, all of the amortization and depreciation of the listed form and the form that we put together, the adjusted net capex comes to be about $500 million. So that's pretty good growth in capital expensing. They didn't have any acquisitions, right? I don't think so. See it. Net debt. The stock option issuance. After netting out new stock issuance to net treasury purchase of 464 million, and then dividends paid. Okay. Now to the balance sheet. A little bit simpler. Got $1 billion in cash on the balance sheet. It's pretty sweet, pretty high, highest amount since 2017. Another 350 million in marketable securities. Receivables. Inventory. Property, plant, and equipment. What am I doing? Wrong button. Hold on. Find me. Oh yeah, well yeah. Okay. The wrong keys. Goodwill. Intangible asset. Other, which includes deferred tax assets plus long-term marketable securities plus other. 556.4. What am I missing? Operating rights piece of usage. I think that was what I'm missing. Right. I think 573.4. 5734.4. I mean, okay. For debt. No, see. Nothing to list there. Payables. Plus accrued compensation, I count that as payables. Other gets 538 million in current liabilities. Long-term operating lease liabilities, 148.3 million. What's happening here? How that changes that so dramatically. I mean, like I said, I still have to put like a million other things in, but I'm just a little baffled by that one. How that just made that jump like that. But it's completely irrelevant. It's going to make a difference. Deferred income taxes. Other 1.02.1. Okay, so we got that correct. Equity, common stock, hidden capital, retained earnings, accumulated other, treasury stock, which is listed as negative, so we reverse that. Is there anything else? I can't remember. 734.4. We have that correct. Okay, so simple enough. We got all that in place. Now we just have to actually put the projected numbers in. But yeah, so I got through that pretty quick. One quick little thing at a time. If you're watching and you're enjoying, please subscribe to the channel. Please like the video. All that, share around. I would normally tell you how I do this 3 times a week on a regular basis, put out other videos, but for the next 2 weeks, who knows what my schedule is going to look like. So, and I'm possibly even longer than that, honestly, depending on how crappy my new roommate situation is or isn't. Find out. But either way, here we are today. So, lots of stuff to do. Take a look at their sales to capital ratio first, I suppose. Start there. Sales to capital ratio has kind of been below the $1 for capital line for quite some time. It was down, especially in 2020. They were doing lots of capital expenditures. We were showing it's improved in the last 6 months, a little bit closer to its sort of baseline average. The 3-year average is 0.76. If you're looking kind of like over a longer time frame, it's a little bit better than that. 0.85, 9. 0.89, So I actually think we're just going to go with the 5-year average, which is exactly what it is for the trailing 12 months. But I do think that's probably a better estimate of what it ought to be. Than as far as what we want to put the best and worst case scenario up to. I don't think going below 0.5 is necessarily super likely. That's probably pretty low for worst case scenario. It's significantly lower than any of their worst case scenarios as is, 0.67 being the lowest it's gotten to, but we'll put it at that. As far as best case scenario though, it's sort of the same thing. 1.5 is probably a little too high. Maybe 1.25 might be better. It's a little bit higher than its best year, because they can get a lot of sales. I do actually have a generally positive outlook on Skyworks. I know some people that work for the company, so I talked to people on the inside a little bit, very familiar with it. I almost got hired by them at one point, actually. So it's like I'm pretty familiar with the company, and I do think they have a very strong competitive position. But for them to get more and more revenues, they really do have to expand their capital base. So it's like you really can't push that too far. It's like looking at the industrial grouping for semiconductors, it's at 0.75, and it's at 0.75 for a reason, which is that fabs are expensive, and so if you're fabricating semiconductors, you need to fork over the capital to do it. So really, this is about as good as it's going to get. 0.5 to 1.25, which is pretty good. As far as the analyst number goes, we can maybe put it like 0.9 or so. Might be. Maybe 0.95, maybe, to be generous a little bit. Look at their debt to equity ratio, which are definitely not 50%. As you can see, they obviously have a very low market value of their debt. It's 203 book listed, but it's still basically a market value basically about the same. It's mostly just equity that they're funded by. That's probably damaging them to a degree, but they probably don't want to go up to 50% either. They're currently sitting at a market cap of 32.1 billion. So even if we assumed that on the worst end of things, their market cap got cut in half, that would put them at 16 billion. And even if they took out a pretty significant amount of debt, that wouldn't really put it higher than like 15-20% at the max, honestly. Which puts their levered beta up to 1.23, basically hardly moves the needle on that, bringing their total risk premium to 6.49%. With the current 10-year treasury, that brings the cost of equity to 7.97%. And like I said, they're mostly funded by equity, so their weighted average cost of capital comes to 7.2%. Pretty high whack because it's all equity, but the cost of equity itself isn't terribly high. Just kind of in line with its industrial grouping. Now, part of the reason this number is so low still is because we haven't adjusted the margin. As you can see, the 3-year average for their margin, corrected for R&D amortization, comes to roughly 30%. If you look back over the years, you can see that it's been a little bit higher than that, been a little bit lower than that. But that's pretty much in line with what it's been. If you assume maybe it gets crushed down to like 15% in the worst case scenario, the industrial grouping for them is 23.25%. So it's like if it came to down 15%, that would probably assume that they lost a lot of the business from their major partner, for example. If we bring high end up to maybe 40%, which would be incredibly high for a semiconductor manufacturer. You could argue maybe, like I said, this could still maybe be only 20, but that wouldn't be only be a little bit below their industrial grouping, so it's like maybe a little bit, I don't know, 16, 17%. Look at their presentation deck, you can see like this is their quote-unquote long-term target model. No specifications of revenue growth. They just want to do higher revenue growth in the market, which means they just want to gain share, which is nice enough, whatever. 53% gross margins, where we don't really look at gross margin projection that much, but operating margin comes to 40%, which operating margin is a rough enough proxy for net income margin because, like I said, they don't really have any debt. So it's roughly the same. The only difference being the fact that our net margins are R&D amortization adjusted, so it's not quite the same. 40% margin would be like a 45% margin for what we're doing here, roughly. A little bit more complex than that. You'd have to see, like, for example, R&D as a percentage of sales, for example, comes out to 11%. So if, and considering, like I said, the amortized amount is roughly half of that, or a little bit less than half of that, so you can say maybe like 5% is sort of what that comes out to be. So sort of based off that, you would assume that our number would come to like 45% in there. So they're sort of assuming long-term adjusted debt margin of 45%, even, but that's sort of assuming no debt. Free cash flow margin of 30%. So that basically assumes like they expect to be able to keep a huge amount of revenues in the margin and just have to pay for them primarily through capital expenditures. So I don't know, we can maybe push this up 45% high end, assume that they achieve their target there. Longer term average 28%, but the amortization doesn't really start to kick in for the first few years, so it's not really a super accurate way to measure it. 29.55, 29.85, still in that 30% range. Maybe pull the bottom end a little bit. Brings the midpoint to 31%, the expected level to 30.85. I just don't see how they can grow that much without having to make pretty significant capital expenses. And we haven't actually even put any revenue growth in, so that's the other thing. We haven't even gotten there. And I'm not so sure that's going to look super great. They have really great margins, but their sales to capital ratio is still below 1 on an expected basis. It only grows above 1, some of the better end of cases. So you could argue, like I said, this is maybe a little too low. Five. That's about as generous as I can be to that. Then revenue growth, where things get a little bit more choppy. They were growing very, very fast for the period between 2011 2016, and it's kind of been slowing down. It was going pretty steadily fast up through the 2012 to 2018 timeframe. So from 2011 to 2018 is a pretty consistently fast pace, but then it slowed down rather dramatically in this time frame, which is sort of after the last phone cycle. ended, and we've kind of been in this lull period since then. So the argument is that it's going to speed up rather dramatically again. Obviously, it did speed up in the last 6 months, very, very dramatically. So question is how much of this year-over-year 30% figure is going to cycle into a 5-year COGR period? You could say maybe on the high end that it goes all the way up to there, but on the low end that it basically doesn't really move at all because of the fact that you can see that it didn't do that. So you could almost keep a range that wide. But even so, you could say that that's maybe a little bold, 25%, and maybe up to 5% on the. If I want to pull the low end up to 5%, and I kind of don't really want to pull the high end all the way up to 25% though. So it's like if I'm really gonna do that, I sort of want to keep it there because I'm willing to admit that they're probably not going to have a COGR of 0%. It's probably just they had its COGR of almost 0% in this time frame right here, but that's because of a somewhat of a downtrend in the overall growth. But that they had a much higher concentration of their revenues coming from Apple several years ago compared to where they are currently. They've been doing a good job of diversifying, so I think that that puts them in a better position to avoid that problem after the next phone cycle. That's why I'm willing to push their low end up to 5%. But like I said, I don't really want to get too crazy with the high end. So 5 to 20%, I think is a pretty reasonable place to leave things. One second, I'm just gonna grab a second drink. I'm back. More caffeine. Again, if you're watching and you're not subscribed, please subscribe to the channel. All right, so let's take a look at what the analysts are saying. Analysts are expecting a EPS growth for the next 5 years of 18.3%. It has to be taken into account relative to the 60 to 75% of free cash flow return to shareholders that they're expecting to do. They do have the dividend that we saw, but it's a pretty small payout ratio, all considered, like 20% or something like that. 20-25%. So the majority of that is supposed to be coming from share buybacks, which means that when you take into account the fact that the analysts are expecting, as I said, a 18.3% EPS growth rate, it's probably more like 12 to 15% in actual net income. It's sort of just like a rough estimate. I'm kind of just throwing a number out there, but whatever. What do we currently have it set at? Apparently to be negative 2.41%, but again, that's because I have 0% in the analyst growth rate. So if you kind of just throw a number in there, let's see what 10% looks like. It pulls it up to 7.34. Maybe put it up to 15%, 12%. See, so, and I think that makes sense because I mean, like I said, my mid end was sort of in like the 12.5 range. The idea that the analysts are a little bit more bullish to me, which is usually generally the case. So that makes sense. They're expecting maybe about a 15% revenue COGR if you work backwards from the EPS expected growth rate, just using also, like I said, the sort of the expected margins that we have on this, as well as which is what they seem to say. But the analysts are also probably a little bit more bullish on the margin area too, to be fair, which increases a little bit much. Makes me sort of want to pull this down a little bit. Maybe not. I don't know. Pull open Yahoo Finance. $29 to $30 analysts estimating earnings for them. 27 to 28 estimating revenue. Yeah, they're expected to do 49.2% revenue growth this year. As you said, they've already done 30%, so there's perhaps another 20% on top of that coming in the next 6 months. But then they do massively expect it to slow down to 4.6. There's a pretty significant downward move in that growth rate, because they're expecting to do a lot of these chip sales this year for then to slow down the next year. If you just take those two numbers, multiply them together, 56% over 2 years. Let's work backwards to find out what the compounded rate is. Compounded growth rate comes to about 25% for those 2 years. But the point is, obviously, they expect the slowdown to happen. So it's very, very cyclical semiconductor sales, because of it being tied mostly to phone RF chips. So, yeah, the idea that it slows down to 15%, I think, is not at all unreasonable. As I said, I'm assuming that they probably do keep the margins pretty high, so we could maybe pull the analyst number down a little bit to, like I said, keep that the logic of it in line, which if it does have that slowdown, that makes a little bit more sense. 14, 18.3. You can maybe leave it there. Okay, so I mean, as far as revenue expectations, margin expectations, capital expectations, I'm fine with all of those things. Those all make sense to me. The only thing that's a little bit iffy is the debt expectations, because I mean, like I said, they're probably not going to issue a whole bunch of debt because of the cyclicality of their business. It's actually sort of to their benefit not to do so, even though it would make the expansion for them cheaper. But it doesn't necessarily make a huge difference to their value, as you can see here. Having higher debt actually helps their value a little bit, but we'll leave it on the higher end of things, just on the off chance that they do issue a bigger amount of debt. But even if their market cap was cut in half, they would have to massively increase their debt levels in order to achieve that. The market cap gets cut in half, then they would still have to triple their debt level in order to do that, which, I mean, like I said, the debt that they have is primarily just lease debt. Yeah, it's just very, very low amount of debt. Which is going to make their default look really great when we get there, but we'll get there in a second. But yeah, I don't know. I think, taking a look at the probability distribution. Gotta stay in my lap. Don't hop up there. You look at the probability distribution. Do I want to adjust this? I'm relatively bullish on my expectations of Skyworks, but I think I actually put most of that bullishness into the actual numbers already. I don't think I really want to boost the distribution much, nor do I really want to punish them on it either. So in fact, if I was to do anything here, it almost would be to punish them. I would almost maybe be tempted to pull 5% out of the middle and put it into the secondary area. It's not like a major punishment, but I think I'll just leave it alone. So then pretty much all that's left is to adjust for default risk. Which is incredibly low for them. Put it at 0% for these two best cases. Maybe argue for top three, actually. And then 0.69 for the rest of them. So yeah, I think that's about it. This is what we come up with for Skyworks Solutions, ticker SWKS. Current U.S. Treasuries trailing around 1.48%. The mature market equity risk premium comes to 4.77%. The discount rate that I come up with for them is 7.97%, primarily on the back of the industrial segment that they're a part of. The current dividend is about 1%, a little over 1%. 5 years ago, they had sales of $3.2 billion. In the most recent 12 months, it's been $4.3 billion. It's a sales CAGR of 5.6% during that time frame, which normally it's a little bit lower than it sort of looks like, partially because of the cyclicality of the revenue growth of their business, because they are a huge part of the phone chip market. So going in between the different phone cycles, that means that they have a pretty solid lull period, which 5 years ago they were sort of entering into that lull period. So that's definitely makes sense why it's a little bit lower of a number relative to the projections that we give them. But anyway, sales to capital ratio for the last 3 years on average has been about 0.85 compared to industrial groupings of 0.75. Returns on invested capital coming 22.84%. Basically, about zero debt to equity ratio is a less than 1%, just lease operating obligations. Basically no default risk currently. R&D adjusted profit margins in the most recent 3 years on average has been 29.83% compared to industrial grouping of 23.25%. So they do better in both the sales to capital ratio and the profit margins than their industrial grouping. They do fall into the logic I've talked about before, where it's like if you have a sales to capital ratio that's relatively low, which I consider below 1 to be sort of lowish in that category, then you tend to have higher profit margins. And I don't know what number I would call the line for that, but maybe like higher than 15% profit margins is generally up there. Profit margins, especially higher than 20, that's definitely getting up there. So close to 30% in R&D adjusted profit margins with a sales to capital ratio below 1, but not like crazy below 1. But so that's pretty great. But the fact that they're doing better than both of the industrial groupings is great. That's actually a pretty significant sign. For example, like I said, they have a huge concentration of their revenues coming from one customer, which means it's a pretty good relationship for them. Like they probably managed to charge a premium to that customer relative to maybe what they might have had to do if it was a rather diversified set of customers that they had lower bargaining rates with, which is interesting because, like, for example, a lot of times if a company is reliant on one major customer, then that one major customer often has more power over that person. But in this particular case, that customer being Apple, they seem to be scratching each other's backs pretty nicely. It becomes a good relationship, see, when you have, especially for like a company like Apple that is really obsessive almost to the control level of their chips. I mean, to the point where they're pretty much entering into the chip manufacturing business themselves, because they're like, well, screw it, we're gonna make our own chips so we maintain control the way we want. But the point is, if you have relationships like this with Skyworks and other companies, then they are actually in a position where it becomes almost difficult for them to break off that relationship, because that customer has or that partner has so much of your specifications like already kind of like sort of built into the system. It's like they're used to having Skyworks chips, because Skyworks has been in so many other products, and so it would require a large breakaway from their current mold of things, which would disrupt the ecosystem that they try to create. I mean, like I said, they are working on chips, but that has nothing to do with these particular types of manufacturing. It has to do more to do with like the dynamics of other parts of the fabrication business involving like Intel, TSMC, Samsung, and other things like that. So it's a little bit of a different reason why they're making their own chips. But it is interesting to think about. It's like if Apple does get their own chip manufacturing system off the ground rather significantly, who knows? That could be a negative sign for a company like Skyworks. But in the short to medium term, I don't think so. I think that they would still work with each other pretty significantly. Uh, but yeah. So anyway, their most recent year profit of $1.4 billion or so, currently selling at 191.32. We're using our pretty much standard normal probability distribution for things, and with that we come up with a set of revenue expectations of anywhere from $5.5 billion in 5 years, possibly all the way up to $10.8 billion, which is a pretty wide range of sales CAGRs, which is perhaps the part where I'm being a little bit on the bullish end of things. Like I said, I was perhaps maybe tempted to put some of the probability a little bit further down the line, whether it's from the fourth model into the third model, maybe by 5%, or third model into the second model by like 5%. I decided not to do that. Just kind of look at this more on the bullish end of things. But you could argue that it could go that way, and that would definitely bring the number down a little bit, but not majorly so. It would maybe bring it down into the 160s or something. But either way, expected sales 5 years from now of about $8 billion, which gives them a 12.73% growth CAGR during that time frame, which, like I said, is pretty significantly higher than the last 5 years, but that's partially due to the lull in the sales that they've already seen for the last 5 years. It's like they have their sales basically go nowhere for like 3 years, and then it's just started to grow again in the last couple of years. And for example, we are, like I said, in the last 6 months, it's grown dramatically. So that's a pretty much a good sign that we're moving into that. And like I said, the analyst expectations seem to believe that it's going to grow for the next 6 months as well, pretty dramatically. And it's going to slow down next year, which I don't know. Maybe it's not going to slow down next year that much. I mean, it'll slow down, but maybe not as much as the analysts say. So that would put them in a good position to get where I'm talking about in that revenue growth. Sales capital ratio, I'm assuming it goes back up to sort of where it was during the last phone takeoff period, so maybe back up to 0.91, which would be still above their industrial grouping, pretty strong, bringing their returns on invested capital up to 32.92% or so, perhaps on an overall distributed basis. Debt to equity ratio, I'm actually assuming that they take on more debt in order to do a lot of this growth. That's actually a way in which I'm being a little bit helpful to them in some regard, but they basically have like no real default risk during that, because they just have kept their debt so low, which basically puts them at very much no chance of default. So that's good for them. R&D adjusted profit margins, we do assume stay in roughly the same range, around the 30% line, maybe go a little bit higher than that. They seem to believe that they can get their profit margins much higher, as the company themselves believes that. And that's the part where I'm like, wow, you really seem to believe that you're going to get 40 to 45% net margins, or at least that's what we kind of work backwards from, because they're talking about a 40% operating margin, when that's basically the same thing as their net margin, because they don't really have those other factors to it. I mean, it's a little bit on the higher end of things because that doesn't include the taxes, but still, in my opinion, it's a pretty high assumption that they're working with. Like, for example, the operating margin that they're currently at, 31.09%. So it's still assuming that they're going to get their margins pretty significantly higher, and I'm not so sure about that. You could argue maybe this is me being a little bit too high on that end. In fact, maybe we should pull it down a little bit further, because I didn't necessarily take the tax part of it super hard into account. That might be actually a better number to roll with, 40% or so. Maybe pull this back up. maybe I'll leave it that way and leave the revenues as it was, because that was being a little bit. I was kind of forgetting about taxes a little bit there for a little bit when I was doing that math, which makes more sense. But either way, it's still pretty bullish set of assumptions. Either way, leaving the profit margin assumptions around, I brought it down a little bit under the 30% line, but down almost 1%, but it's still around 29.5%. That's still pretty high, which it does bring the value down pretty high because it's mostly that outstanding upper bound of probabilities that was pushing it so high. But either way, so that gives us a distributed R&D adjusted profit of maybe $2.4 billion in 5 years, which is pretty strong, bringing the present value based off of the discount rate that we use for them up to 163.38, which puts them to be a little under 15% overvalued. And we have 5-year forward value targets unadjusted for the dividends that they pay of $88.70 all the way up to maybe $439.05, and on a probability distributed basis, $239.76, which based off the current price they're selling, that would give you an implied 5-year forward CAGR of 4.62% per year for the next 5 years. On the multiple regression output, comes out to be a pretty generous set of numbers for them based off of the fundamentals that we put for them, as well as the growth rate that the analysts are assuming for them. Gets a suggested multiple base pricing of possibly $236 per share, which would definitely perhaps explain why the price is so bullish on that, is that it's being a little bit discounted based off of that basis, but it does still fall between the present value and the 5-year forward value. So it's just much closer to the 5-year forward value. So based off of short-term pricing metrics, the market does seem to believe that there's perhaps upside to the stock, which would explain why it's pushed so high. It is in a pretty high growth tech sector. It's very much in vogue, part of the semiconductor business. It's one of the Apple suppliers, like I said, which is generally considered to be a relatively secure part of the business to be in. So yeah, that's Skyworks. I feel pretty confident with that, especially now that I brought that down. I felt like I was being too much bullish in a lot of the areas between the revenue growth, as well as the debt, the debt issuance. Like I said, I honestly just don't think that that's even necessarily going to happen. And that was actually helping them, as well as the margins. But having brought down that margin a little chunk, that makes me feel a little bit better. That puts it a little bit more in line with what's actually probably more reasonable to assume. So yeah, this is what I come up with for Skyworks. Pretty great company. I've owned them in the past, sold out of them based off of the numbers I'm seeing here. Sort of wishing like I didn't sell out of them, but they're definitely not really in buy range for me now. So yeah, is what it is. Good profits is good profits. Now we're going to look at some of these extra tabs I have here. Going to look at the new watch list thing that I have, which I've built out over here. All the companies that we've valued on stream. We're going to first transfer in Skyworks. Down here. Then copy the link. Switch that over. Look, hopefully this is all in line correctly. Let's go and line in. Copy in the information correctly. So give me a second to do this. Things in here that fully white columns have to pull the line down. Like this one today, so we'll go ahead and throw that in there. Okay, so let's input these. R&D adjusted EE. For discounted PE, which I'll get into exactly what that's about. Got some interesting ratios in here that people probably don't normally see. In a slightly different way to think about multiples that a lot of people probably don't normally think about. We value dividend for okay. So explain how this works. This is kind of a little spreadsheet I came up with to basically try and rate all the companies that I valued based off of how good of a buy I think they are. Because there's sort of many ways to look at whether or not something is a buy. Something I've sort of already I've kind of talked about some of these little pieces in passing. In general, I sort of look at the expected COGR of a stock, but there's a little bit more complex than that. Firstly, you have to understand exactly what the formula is in order to explain what the expected return for a stock is. There's a lot of value investors think about valuation in a very kind of limited sense. So we're going to try and think about it a little bit more conceptually. It's like most, let's say most, but a lot of value investors sort of only think about the cost of equity, assuming that what you're doing is the valuation based off of that as the expected return of the stock. Or if they're valuing the whole enterprise and then subtracting out the debt, then they'll use the weighted average cost of capital. But a lot of people get those two concepts confused and don't actually necessarily understand what that's supposed to be. The weighted average cost of capital is supposed to be the expected return on the total capital for the entire enterprise, which includes the debt, which is why you're weighting together by the debt to equity ratio the cost of debt and the cost of equity. Cost of equity is supposed to be the expected return for the stock for the equity investor. Discount rate, cost of equity, expected return, all these terms are relatively interchangeable depending on what you're talking about. Now, there's a lot of arguments or debates in the investing community, the DCF community, the value investor community about how you're supposed to discount things and what they're supposed to mean. Now I kind of fall between there's sort of like two major camps, and I sort of fall in between both of them a little bit. And that's because I think both of them are right in certain ways, and they're just not necessarily thinking about everything correctly. Calculate it for a reason. So we're going to do some math to show some stuff. Now, the concept of using weighted average cost of capital is that you're essentially trying to find out what would be the return on a similar asset with a similar risk profile, and you're using that in order to come up with the expected return for the stock, assuming the stock is already trading at fair value. This is based off the capital asset pricing model, CAPM, which basically assumes that all information about a stock that's available is already out in the public, and that therefore the individual investor can't actually essentially get a leg up on the market. And what you're supposed to do is simply have a diversified portfolio of stocks based around what the pricing of the capital asset pricing model tells you to use, and then that's going to be what the return is at fair value, because it sort of assumes stocks are already trading at fair value, which is why people use beta, the reported beta, which is what we sort of have here. The number that's right here is the reported beta as per Google, but it's what beta is the variance of the stock, or the spread of different returns on any given day relative to its actual returns. And so it's basically saying how volatile is the prices on any given day for the stock, or month, depending on how you calculate it, relative to the actual returns received for the stock. So if you have a beta that's 1.5, it's basically saying that the variance between the overall spread of individual prices you might see on any given day is 1.5 times as volatile as the return that you're going to receive for that stock. If you have a beta of 0.5, then it's going to be 50% as volatile as relative to the return of the stock. So this comes out to be a part of the calculation of the cost of equity, because it's basically saying that something that's more volatile is more risky, because the risk that they're determining it based off of is saying that because of the fact that on any given day you might have to sell the stock, therefore the chance that you are going to have to accept a price that's lower than your principal is a little bit higher, and therefore volatility is a measure of risk. And then a lot of other value investors say, well, that's ridiculous, because the more volatile the stock, the more opportunities you have to buy more shares at a lower price, and therefore high volatility is not actually risk, especially if you have a long-term perspective, because it shouldn't really matter what the prices are going to be on any given day. It helps you out essentially to have more volatile stocks if you're going to hold them for the very long term. What matters is how undervalued it is. And so there's sort of like two camps of thinking on this, which is why some people don't like using CAPM or betas, and they just use an expected return or a hurdle rate to calculate what their discount's going to be. They'll just say, I want 10% discount on everything because I want a 10% return. So therefore they'll just use a 10% discount rate, and therefore if it's undervalued at all, that means it's a good buy, because it's going to be you're going to get your 10% return. But what that means is they're essentially automatically assuming that every single stock is equally as risky. So there's one camp that believes volatility is a perfect measure of risk, and there's another camp that believes that volatility is not a risk measure at all, and therefore they don't use any risk measure. I agree that volatility is not a perfect measure of risk, but the idea that all stocks are risky, which is what you're implicitly assuming when you just use a 10% discount rate for everything, is kind of ridiculous. Which is why I use a kind of a slightly different method. I use an adjusted concept of beta that actually takes that problem out. Because if you use the type of method I use, then the more volatile your stock is, it actually has more than one effect on things. The reason why this matters is because with the debt to equity ratio, the calculation of the weighted average cost of capital, you end up essentially automatically implying that you end up with a lower weighted average cost of capital whenever there's more debt in your company. And most people will say, though, that's also ridiculous, because how does more debt equal less risk? Because it increases the chances of default. So what I have is a form of beta that adjusts based off of the debt levels you have. As I've shown, you have an unlevered form of the beta based off of the industrial grouping. It means we're assuming risk based off of the industry that they're in, and then we adjust that for the debt they have. So if you increase the debt to equity ratio, yes, it lowers the weighted average cost of capital because of the fact that you're using the higher portion of the interest rate, which typically is a lower rate than the cost of equity, but you're also increasing the beta when you increase the debt to equity ratio. So essentially you don't get a free lunch. You don't just automatically make your valuation higher just because you increase the debt to equity ratio. It depends on the industry, it depends on the tax rates, it depends on the interest rate, because you're also going to be increasing the beta. Which one increases at a faster rate kind of depends on those other factors. So that's what it's called a bottom-up beta. It's a concept that's popularized by Aswath the Motoron. He's got like whole videos and lectures on the concept, but it's very, very different than the reported beta. You're not just using the variance of one individual stock. You're essentially using a fixed average of the betas of many, many companies depending on the industrial sector. You're starting with the industrial sector. You're working backwards to find out what it would be like if you had a company in that industrial sector that had no debt and no taxes and no interest rate. And then you're applying the individual characteristics of your company based off of those factors to come up with a much more specialized and particular form of risk measure for that individual company. So anyway, the reason why this all matters is that I'm trying to explain why both methods are wrong. Like I said, the hurdle rate concept, the expected return concept of just slapping a 10% or a 15% or a 20% on there and discounting everything on that is wrong, because you're not actually measuring for risk. You're not actually doing anything. You're just discounting and basically saying, oh, well, if I use a high discount rate, then therefore it's safe because I'm just making sure that things are undervalued. And that's true in some senses, but what you end up doing is you're assuming every company is equally risky. Is a utility stock really equally as risky as a telecom stock? Is a telecom stock equally as risky as a semiconductor tech stock? Is a semiconductor tech stock really as equally risky as a consumer packaged goods stock? Not really. It really depends on the industry. See, like different industries have different levels of risk, and so that's why I think this concept makes much more sense. And then, like I said, each individual level of leverage does matter for the company. The reason that the hurdle rate crowd, like I said, they argue that that CAPM is bad because CAPM automatically makes companies with high leverage have a lower discount rate. And I agree that's wrong, but that's because the cost of equity doesn't adjust upward for the levels of leverage. Yes, having high leverage should lower your weighted average cost of capital, but it should also raise your cost of equity, which would therefore have almost like a balancing effect. But it depends on the individual characteristics of the company, which one wins out. So that's what I use, which is why I think that CAPM is useful. You just have to adjust for some of the rational flaws in that methodology. But now that it gets a little bit more complex than that, because what CAPM also tells you to do, this is one of the areas where CAPM is wrong. CAPM tells you that you can buy anything just under its fair value with CAPM, and that's going to be enough. Now, this is something that the hurdle rate crowd sort of also agrees with, and that's because they're not actually trying to calculate what the real return is going to be. They just assume that the expected return is the expected return, and if it's undervalued, well, then you're getting extra icing on the cake relative to the expected return. But this expected COGR that I calculate is essentially saying that doesn't make sense. What I do is I start with the fair value of something and the current price of something, as well as the discount rate, the expected return, and try to find out what the real expected return is based off the fact that it's not actually trading at its current fair value. So like sort of explain what this is, how that works, is that you can say that we'll start with Ingalls Markets here at the top and just kind of explain how that works. If you have fair value, it's 94.04, and then its cost of equity is 6.34%, then therefore the 5-year forward value is 127.87, which is that if you multiply it by that return for 5 years, should be getting a roughly 36% return over that time frame. Multiply it by that original price, and voila, you end up with the 5-year forward value. So if that's what the value of the stock is supposed to be in 5 years, then you work backwards from that fact to what the current price is, which is actually 58.07. So if you divide that by 58.07, it means that the fact that it's that much undervalued means that over that time frame, you're actually going to more than double your money. You're going to get 120% return in total. And then if you find out what the compounded return over that time frame is, you end up with 17.1%, which is what the expected return is here. Now, the formula I have here is a little bit more complex than that because it gets a little bit weird. You can see it what this formula up here essentially shows is saying that if you assume fair value is 1, and you assume that for example, the current price is 5807, so if you have 5807 over the fair value is 94.04, which gets you 0.617. So if you have 1 over 0.617, that would get you over 58. You have to do this kind of formula form. 94.04. So if there was no expected return, if it was going to go nowhere, and you just assume that it goes from the current price up to fair value, the total return would be roughly 62%. But then on top of that, you essentially have to add this return per year, which is why, so instead it's actually 1.0634 to the fifth. You get it for 5 years, so 1.356 or 1.36 or so over that same ratio of what I was saying, the current price to the fair value is 0.617, and then you calculate that, you end up with 2.20, which is that 120%. So we end up getting the exact same number that we came up with before. See, and then if you, like I said, well, you'll end up with the same number as you did already over here if you divide out the number there, because it's the same number. So therefore, you can end up with the expected COGR during that time frame. So essentially, that's what we're doing. We're combining together the fact that you're supposed to be getting the expected return for each year for the 5 years, but we're also assuming that it returns to fair value during that time frame, and that's essentially what the expected COGR is. And that, in some senses, is sort of like what the real expected return is, based off the fact that it's trading under value today. And so, in some senses, this is almost like the most important number to me as far as like deciding whether or not I want to buy a stock, because I want to have high total returns, and this is what I think is going to be the total return of the stock during a 5-year period, assuming that it trades to fair value during that time frame. Some stocks may continue to be undervalued for 5 years, so that's not necessarily the case, but it could also go way past that too. So it depends. It could only take a year or two to return to fair value. It doesn't have to take 5 years. Sometimes it takes 6 months to return to fair value, but it could also take 10 years. So who knows? But the point is that's generally what the expected COGR is. Now, like I said, a lot of other people, both in the CAPM camp and in the hurdle rate camp, don't really calculate an expected COGR like that. They just think about what the expected return is, and they think about that as a return that you're not going to get, and they only look at what the upside is. A lot of people ignore the discount, and they basically say that the discount isn't even a part of your return. They just look to see if a stock's undervalued. They buy it if it's undervalued, and then they hold it all the way till it reaches fair value, and then that's the return they take, and then they sell it. This is the thing. It's like, it doesn't make sense to me to sell something just because it reaches fair value. You should sell something when it's way past fair value, because at fair value, you're still expecting to get the cost of equity. I hope the way I've explained this makes sense. But the point is so a lot of people only buy and sell stocks based off of the upside or the downside from fair value, which is what this column is. But in my opinion, you have to combine this with this, and that gets you this number right here. So, but there's more factors that go into it. That's just one way of measuring it, and it's all based around a lot of the assumptions I put into it, which is sort of what this spreadsheet is meant to do here, is it combines a lot of other factors in place. Now, on each individual stock, I have added together a few other factors, not just this and this, but it includes quite a bit of this. But I combine these factors together to come up with something that I'm calling a value score, which I'll explain by showing it on Skyworks, because it does actually have it on Skyworks. Give me a second to do that. Apparently, this weird. I have this happening. So I have this thing that calculates it, and I do it for every single stock. Firstly, we're multiplying the amount that it's the value upside, so just the value upside that doesn't take into account the cost of equity, and then we're multiplying it by this number 52, which the 52 is essentially the weighting. That's what this entire line is. It's just the weight for each of these measures, and then I add them all together into 177 points. So 52 points out of 177, so like somewhere between a quarter and a third of all the points, it gets weighted toward just how over or undervalued something is. And then 38% of the 38 points out of the 177, which is still a pretty huge percentage of the points, gets weighted towards the COGR. So we're weighting a pretty significant amount to how over or undervalued something is, and then pretty significantly to what the actual COGR is. But it's not the COGR by itself. We're taking the ratio of this COGR to the discount rate. So anytime something is overvalued, this COGR should be higher than the discount rate. Anytime something is lower, so is overvalued, it should be lower. In this case, you can see that it's overvalued and it's lower. 4.62 over 7.97, which gets you a ratio of about 58%, and then multiplying that by the 38 points. So we're getting those points together. So it's overvalued, so it's a negative amount of points added together with a ratio that's low, so it's a positive amount of points, but it's a low amount of points. Then we're doing the same thing with another thing, which takes the COGR and compares it. This is just the COGR by itself. So we're weighting in a decent amount of just what is the total return, irrespective to whether or not it's over or undervalued, which basically is almost what you could look at as value growth. This is almost what I think about as the difference between value and growth. Is almost like whether or not you're buying something that might be overvalued, but there's still returns associated with it because of how much it's going to grow. That's what people often think about as growth. Is like, oh, it's a high PE stock, but it's going to grow so much that it's going to grow into that PE enough that it makes up for it. This is almost like the DCF equivalent to that, if that makes sense. So you get some points for it, which basically means is like you could buy something that's overvalued as long as the expected return is high enough. In this case, it's not very high at all, but the point is that's what that shows. Then I also weight in this ratio multiplied by that number, and then the ratio itself is similar to taking a ratio of the expected COGR to the discount rate. Instead, I'm taking the expected COGR as a ratio to the expected return of the S&P 500, because some stocks have really high discount rates because of their debt profiles. And while that's sort of a punishing effect, in this case, I'm trying to ignore that and give them almost like a little bit of a boost just for the fact that they're a higher expected return than the market, regardless of what their debt profile looks like. So this is something that might give me extra points towards highly levered companies. But in this case, I'm willing to accept that fact. Basically saying maybe we want to take on some high risk stocks because they're going to give us some high returns in this particular case. But it's weighted down. It's only 21 points out of the 177. Now then we do the same thing with this next measure, which is kind of a slightly different concept. In this case, we're sort of looking at like the sensitivity of the values. Because we have all these different 5-year forward value targets, and I distribute them based off the probabilities. But we're actually going to take a look at is, well, what's the best case scenario I came up with? Because the best case scenario I came up with is $439, which is so much higher than its current price that it's almost ridiculous to just ignore that. Yeah, I only weighted it in about 5%, but the point is well, maybe like, you know, you don't want to sell something too soon if it has some tail end probabilities that are so dramatically high that it's almost worth holding on to, even if it's overvalued, just because, well, what if the best case scenario happens and then you missed out on that? So the point is, where did we take the ratio of the best case scenario to our expected case 5-year forward value? And we're saying it's like, okay, well, what's the ratio of that? Because if the tail end probability is so far out there, that'll make that ratio higher. And then we multiply that ratio by, in this case, 13 points. So it's a pretty small amount of points relative to just the over under value, but it basically gives a little bit of a boost to stocks that have these high tail end probabilities. Now, to counteract that, we do a slightly different, where we say, well, what's the worst case scenario? Because we also have that in here too. So I take what is the minimum number of these 5-year forward value targets, which gives us the worst case scenario. And then we take the ratio of the worst case scenario, not to the 5-year forward value target, but to its current price. So we say, okay, what's the stock's current price like compared to what we think is maybe the worst case scenario for the next 5 years? And then that gives us a ratio. In this case, it becomes a much lower ratio. You want to have this to be a higher ratio, but it's usually a low ratio. And then we weight that by a certain amount of points too. So we want to take into account what is possibly the best case scenario, but what is also possibly the worst case. And we give those together, those come out to be 20 points out of the 177 points. So it's just a little bit of a push. You know, it's like I said, the majority of the points is made up by these first two measures. Literally the majority. We end up with 90 points here, 90 points out of 177, which is doubling that would be 180. So a little bit more than half the points are just based off of how over or undervalued it is. If we include all three of these as the over or undervaluing, you end up with even more like 2/3 of the points. And then, like I said, you compare that to the normal market returns, include that all together, and it's really definitely like 2/3 of the points. In fact, I think it's more like 137 points out of the 177 is based off of just what the expected returns are in different ways to measure it. But then we included, like I said, another 20 points based off of sort of like the tail end probabilities, both on the high end and the low end. Now, the last few points, which is itself makes up only about 22 points, so it's a little bit more than these two together, but it's three different measures, gives us a little bit more of a push, a little bit more of a kind of like just a little bit of an edge. And this is specifically designed to make sure I don't sell things too quickly based off of the fact that it has really, really strong fundamentals. If something is really, really overvalued, but it has really good fundamentals and competitive position, then you maybe want to be slower to sell that stock than other ones, even if it's overvalued by your measure. I mean, what if you're off? You know, you can be off by a significant proportion. And how we come up with that is we are looking at their margins. Now, I'm using an average between two different measures, and I do this for all three of these, which is that I take a look at what their current margin is. In this case, for me, when I talk about current margins, I usually mean the average for the last 3 years, but it depends on what I set as the base year. In this case, I did use a 3-year measure for that, but the point is I might have set it at 5, I might have set it at 9, I might have set it at 1, 2, but whatever average margin that I've used for the past margin, that's what I have here. And then in the second number, I'm actually using the margin that is in D, the column D, which is the 5-year forward margin. So, and it's the expected margin I'm using. So what is my expected net margin 5 years from now? And what is my current past ranged margin that I'm looking at? And I take the average between the two, which basically puts it somewhere in the middle here. So it's basically saying halfway through my valuation, what do I expect the margin to be for this? And that gets me this number down here, 29.65%. So roughly halfway through the holding period I'm expecting, I would expect them to have a margin around 29.65%. And I'm weighting that by 8 points, and that gets me an extra way to tilt towards high margin companies. So it's basically saying the higher your margins are, the more I might hold on to your stock. And I do that with other things too, because it's not just margins that matter, it's also sales to capital ratio, capital efficiency. So I do the same thing there, where it's like their current sales to capital ratio. In this case, and did I use a 5-year? Yeah, I used the 5-year average for that, 0.85. And then the expected ratio for them 5 years is 0.91. So I take the average between those two and end up with 0.88. So if you have a high sales to capital ratio, well, I'm going to take the average of that, and the higher your margins are, the higher your sales to capital ratio are, which between the two of those, I think that sort of signifies what a good competitive position looks like. Like if you want to identify a competitive moat in the numbers, the combination between those two numbers is a good way to look at it. So essentially, it's like the better your moat is in the numbers, the more likely I am to hold on to your stock, because it gives it a small point boost, so that if you're a bit overvalued, you might be able to make it up for that fact with the fact that you have this good competitive position. Now I do sort of the same thing a little bit between this. You look, it's I 195 and B 417. B 417 is the weighted average cost of capital, and I 195 in the I-195 is the returns on invested capital. So we're taking a look at what its current returns on invested capital is compared to its cost of capital, which the difference between the two is what DCF doers and value investors typically call excess returns. So we're taking it, but we're not actually looking at the actual excess return number because sometimes it's negative and I don't want this to be negative. So I took the ratio between those two. So the higher your expected returns are, the higher this ratio ends up being. And we take the expected returns and we do the same thing, but also compare it to what we think the forward expected returns are going to be, and we take the average between those two. So these three measures is almost like looking at, they're almost like just efficiency measures or moat measures, like I was saying before. Like you can say it's like we're giving a little bit of a tilt to companies that are earning more than they ought to earn relative to their industry, both in margins and in capital expenditures and overall excess returns, which is kind of like a combination between the two. And like I said, we're in this case giving them 22 points between that out of the 177. So whatever the total score is, we add up all these numbers on the bottom here, and then all the points that were available here, and we take the ratio between them. And that gets me this number right here, which in Skyworks case is 0.61. And that's what I call its value score. Now that by itself doesn't tell you anything. It's not like there's an absolute number or something where it says like, oh, value score is above this or a buy and value score is below this or a sell. It doesn't matter just based on that. This is a relative measure. This is something where I compare it to many other stocks. So like I said, I just showed you how this is all calculated for Skyworks. But if we go back over to the watch list, you can see I have brought in a value score for all of the stocks that we've valued right here. And they range all the way from 0.14 for Affirm Holdings all the way up to 1.49 for Ingalls Market. Now, like I was just saying, Skyworks is 0.61. That's pretty sort of like a midpoint in here. It's a little bit below the midpoint between those two measures actually. But I also bring in the measure for the S&P 500, which is a little bit of an estimation because we don't have some of those metrics we don't really have for the S&P 500, but I have some of them. The reported beta for S&P 500 is supposed to be 1. The expected return is just the expected return for the market. And what we're doing is we're actually assuming that they're fair value automatically, which is maybe not accurate. But the point is in this particular case, for how I measure this, we just assume it's fair value. And then for the margins and the sales of capital and the excess returns, I'm actually not using the S&P 500. I'm actually using in my data sets that I use for a lot of things, I actually have the averages of all those numbers for a much larger set of companies. It's more like 4,000 companies or like 3,000 to 4,000 US companies across market cap, across industry. It's a very large sample set. But we're using the metrics I have for that, even though that's not technically the S&P 500, but it's more of like a larger cross section of available stocks. But if I use the same weightings and I calculate out what the value score for the S&P 500 is, it comes out to be 0.6. And this shifts around depending on the week a little bit. You might move up a point or two. But the point is this is sort of how I like to look at it. Like if something is a better buy than the S&P 500 or it's a worse buy than the S&P 500, and you can see that. Here's the stocks that I think have a lower value score buy rating than the S&P 500. Anywhere from Google and Microsoft and Netflix and Tesla all fall below that, but stocks I own as well, like AT&T, Store Capital, and Disney, they also fall into this category. Some of the other ones we valued also fall into this category. But the point is the further below that number goes, the more likely I am to sell it. I actually am in the process of slowly selling off shares in Store Capital and Disney. But much like dollar cost averaging is a technique you can use to buy into companies slowly over the course of time, you can do the same thing with selling. Something that a lot of people don't think about. A lot of people just sell all their shares one day and then call it a day. But it's like, well, you can choose to slowly sell over a 6-month period in order to capitalize on the fact that the price could go up a little bit. It could go down a little bit, but it's sort of like the same logic as when you're dollar cost averaging into a stock. It could go up over that time frame. You might be like, oh wow, I should have just bought it all up front. And it's like, well, the same logic can work for selling too. It's like, oh well, I might have just sold it all up front. But sometimes you regret buying it all up front. Sometimes you regret selling it all up front. So that's sort of what I'm doing. I'm dollar cost selling those two companies. I'm not doing that with AT&T, but that's because there's more than one thing that goes into it. I don't actually do it based off the fact that it's below the S&P 500. I just like to have the S&P 500 in here as a reference. What really matters to me is more like the averages and the medians of these figures and standard deviations from that, which like that's what I have down here in these lower columns. The medians, average, and standard deviation for a lot of these metrics. For example, on the upside, so the median stock that we valued has 6% of upside. The average has 6.38%, and the standard deviation between all the stocks is about 25.34%. And then if you look at how many 1 to 2 standard deviations up or down, it gives you a pretty wide range of saying it's like 2 standard deviations, which would cover 67% of the outcomes. Would say that on the low end it could be anywhere from 44% downside to possibly 57% upside. That would cover, like I said, 2/3 of all the outcomes presented here, roughly. That's how standard deviation. And so the same thing with the expected CAGR. We have a median expected CAGR of 8.77% and an average of 8.69% with a standard deviation of 5.43. So 2 standard deviations, 67% of outcomes would include expected CAGRs anywhere from negative 2.17% to possibly up to 19.54%. See, so that's how that's supposed to work. Now I do the same thing with the value score. The median value score is 0.85, which is significantly higher actually than the S&P 500. So a lot of the stocks that I value do have presumably better outcomes available to them than the S&P 500 as a whole. Amazon itself is actually trading at that exact level, with Apple a little bit below it, Barrick a little bit above it. But the average ends up also being 0.85, and the standard deviation is 0.36. So if you look 2 standard deviations below, we get to 0.12, possibly all the way up to 1.58, which in this case, that actually covers the entire range of valuations. Usually you have to go to a 1/3 standard deviation in order to cover, statistically speaking, 95% of the outcomes, but apparently 67% of the outcomes actually covers all of the outcomes. Okay. So how I actually think about whether or not something is a stock or buy using this methodology is thinking about how many standard deviations away it is. If something is going to be a sell, I don't really want to sell it unless it's at least 1 standard deviation below. In this case, anything that's below 0.48. Anything that's below 0.48, now actually T actually sells at 0.48. But it's a little more complicated than that because that's based off of the entire sample set of companies I have, not just the stock I have. And the reason why it's useful to use a value score is that it kind of shifts things up and down a little bit. If I had just ranked everything, because this is currently ranked in order of value score, if I had just ranked everything by upside, you would see that this number would be a perfect smooth number here. But obviously, we have a stock that's only 49% upside outranks stocks that have 52 or 49 or 42 over here, as well as you have a stock that's only 2% upside outranking a stock that's 14% upside over here. And then as I was just showing, AT&T apparently has 12% of upside, but yet it ranks significantly lower here. The reason why is because it has a low sales to capital ratio, it has a low margin, it has low excess returns. And so even though there's high returns still available to the AT&T shareholder, it doesn't have a strong competitive position. What that means. So you can see how that tilt affects things. It's like it might seem like there was only a few points going into those tilts, but it affects it. That's the whole point of doing this. It's the same thing with the expected CAGR. It's not perfectly outlined here. The highest one is 17.08, but we actually have a stock that's 18.33 right here, and yet it's being outweighed by 3 stocks that have better metrics than that. As well as there's a stock with 10% expected returns, AT&T, being outweighed by several stocks that have only 1 figure of expected return, as you can see. So it just shows, it's like even this, like right here, this stock that has 7.69% expected CAGR is outweighing a stock that has 17% expected CAGR. And that's because it has potentially higher margins and potentially higher sales to capital ratio relative to the other company and excess returns. So basically, that's the whole point of the value score, to look beyond just the expected CAGR and weigh in a few other things that are important to the overall long-term returns of the stock. It's not just one number. It's sort of like taking many possible numbers that could reflect possible value and weighing them all together to get this valuation score. And now, like I was saying before, as far as like AT&T, as I was just showing, AT&T is one standard deviation below the average grouping of all the stocks. But I primarily only use the standard deviation of all the stocks to look at when something's a buy. Anything above 0.21 would be the standard deviation above that. It's weird, but it was 1.21. So basically, based off of that logic, I could say that all of these stocks look like they're good buys because they're over one standard deviation above the group that we have here. But what if I only looked at stocks I own, which is what I do over here? Obviously, it's being a little bit weird because gold doesn't want to cooperate right now. So just give it a second to do that, but we can actually maybe fix that. Tools, commodities. It is 1786. I'll just type it in to make this faster. Come on. Give it a second. There we go. All right, there we go. Fixed it. So that's taking the average and the standard deviations of the entire sample set of stocks we value. But if instead I do the same thing where I look at the stocks that I own only, then we actually end up with an average of 1.04 rather than an average of 0.85 and a standard deviation of 0.34 rather than 0.36. So if you take a look at that, you can find that one standard deviation downward from the average is actually 0.7, not 0.48. And two standard deviations down from that would be 0.35 rather than 0.12. And so if I'm looking at buying a stock, I might look at whether or not something is one standard deviation up from the average of all the stocks that I have valued. But if I'm looking at selling a stock, well, that's only amongst the stocks that I already own, right? So the point is, if I'm looking at selling a stock, I might only look at what the standard deviations are from the stocks I own. And in this case, I might not only just do only one standard deviation, I might actually not sell it unless it goes to two standard deviations, which is actually exactly what I do. So the fact that, for example, Disney is at 0.35, Store is at 0.39, which is relatively close, and I think it's actually shifted around a little bit because I think Store capital came down a little bit in the last week. So that's why its value score improved, as the stock came down a little bit, which makes it a slightly better price relative to all those factors. So I think it actually went up, and I think that might have been the case for both of them. So, but the point is both of them are relatively close to that point. So the fact that T is at 0.48 means that yes, it's below one standard deviation for the stocks I own, but it isn't isn't that close or below two standard deviations, which, like I said, so for buying things, I normally look at when something is above standard deviations for the entire group. If I'm looking at selling something, I might look at whether or not something's below the standard deviations only for the stocks I own. And then I use these numbers also to figure out basically how much of a stock I want to buy, when I want to buy how much of it, and other things like that. But that's sort of irrelevant. But yeah, so this is the new watch list I came up with, sort of a new way to think about whether or not I want to buy or sell stock based off of this score. And the fact that, like I said, it has this little metric thing in here, and I can change the weightings around if I want and just apply it to every stock. If I want to decide that one metric needs to be weighted in a little bit more than another metric or something like that. But I'm pretty pleased with this. It took a couple weeks to kind of come up with how I want to think about this, but I'm pretty satisfied with this metric. Now, there's other things here that I kind of want to explain, which is I have the adjusted PE, which is the R&D amortization adjusted PE that I've talked about, or R&D adjusted profit that I've talked about, and using that as the earnings for a PE metric, which is why you'll see in general there's lower PEs than the reported PE, which I also have listed here as well. Not always, sometimes it's actually higher, but more often than not, if it has good R&D spending involved in the company, well, then you'll often find a lower PE in this case. Now, we do the same thing with forward PEs. In this case, when I say forward PEs, it's not based off of the expected growth of earnings that the analysts have out. It's actually based off of the expected growth of earnings that I have projected for the company itself. So these forward PEs and forward EV to sales metrics are based off of the numbers that I've actually projected. That's something to keep in mind. It's taking my own valuations into account, not the sort of the market expectations. I have an expected income, which is based off the probability distribution for 1 year forward. I show the 5-year forward number in the ending valuation summary right here, which is what these numbers show. But I also can do the same thing for 1 year forward. So 1 year forward, 5-year forward. The expected forward earnings for Skyworks is 1.469 billion. 5-year forward, it's 2.433 billion. So the point is I take those earnings, the expected forward PE. A lot of people like to show forward PEs because they tend to be smaller numbers. But one thing that they're not doing is they're not taking into account the fact that you're supposed to have an expected normal return based off of fair value for that. So what you can do is you can take the expected earnings and discount it 1 year backward based off the cost of equity, and then put that under the current price. That's what I do here. It's basically, this is what I would say is an actual expected PE 1 year forward, not a forward PE that's going to be lower because we're taking into account next year's earnings. We're taking into account next year's earnings, but we're also making those earnings lower than what we expect based off of the cost of equity that we calculate. So, perfect example of that, we'll look at Skyworks. Skyworks is currently trading at a PE of 26.45, which if you adjust for R&D comes out to 21.67. But in my opinion, based off of the earnings I expect for them to earn in the next year, I would expect them to actually trade at 23.62 1 year from now, based off of the R&D adjusted profit, not the reported profit. And then I can do the same thing for the 5-year forward, except I got to discount it back 5 years, which means in 5 years' time, I would expect them to trade on that profit at 19 times or so. So the point is you can do it's like a discounted PE ratio. So basically what I'm calling it here. We have an adjusted PE, a forward PE discounted, and then a 5-year forward PE discounted 5 times. So it kind of brings them in line with each other and makes it so that you're not looking at some real low numbers. A lot of people will be like, oh, well, it's trading at 4 times 2025 earnings. And it's like, okay, well, what does 4 times mean if it's 2025? Because obviously, you know, if you think about stock as fair value at a PE of 20 and cheap at a PE of 15, well, who cares if it's trading at 5 times or whatever its 2025 earnings, because you have to wait 5 years to get that. So you have to take into account the fact that you're waiting 5 years, and the way you do that is by discounting the E that goes into the PE. So that's what we're doing here, is to essentially bring these forward PEs in line with the current PE by discounting. And then I do the same thing with EV to sales. So Skyworks is currently trading at an EV to sales of 7.15, but then the sales I expect them to have next year discounted back at their cost of capital. In this case, cost of capital, not the cost of equity, because EV belongs to all the capital owners, not just the equity holders. So you gotta make sure you do that correctly. But if you discount it at the cost of capital, you end up with 6.84. And if you're looking at the the revenue that I'm expecting for them 5 years forward, discounted at the cost of capital 5 times, you end up with EV sales of 5.67. But that's another thing people will often do. Like, oh, well, it's trading at a price to sales ratio today of 7, but it's actually only trading at 2 times its 2025 sales. It's like, who cares? Who cares what its 2025 sales is? You can't just buy something cheap level of that, because you have to wait those years in order to get it. So you have to, again, bring them in line with each other. But again, as you can see, it does go down over time in Skyworks, which basically shows that they are growing at a significant clip. So this is just kind of like my own personal way of thinking about multiples. A little bit different than a lot of other people do. You don't normally see people discounting a multiple, but that's sort of what we're doing. Discounting both a PE ratio as well as an EV to sales ratio. And then, like I said, the earnings that we're using and the sales that we're using are based off of the assumptions that I actually already projected into the valuation. So it's not like it's an analyst-based forward PE or an analyst-based forward price to sales. It's basically taking my already existing valuation and putting those numbers into multiple form and then thinking about it. And then, well, I've also created several little graphs kind of relative to these things. And part of the reason that it's useful to use this forward PE and discounted forward 5-year forward PE is that it kind of gives you a logical way to think about some stocks that are ridiculously high multiples. We'll look at Tesla, for example, perfect example. Everybody knows Tesla trades at a crazy multiple. Its reported PE is 684. In my case, it's 688. If you're looking at the forward discounted PE, it's actually 834. But if you're looking 5 years forward, even discounted back to the present, I end up with a much better PE rate. And see, suddenly all the growth that one might expect on Tesla, granted my Tesla valuation is relatively bullish. I could have been much more conservative in that, but I was actually trying to be fair to some of the bigger bulls. Like, okay, well, let's take some of your assumptions into it and look at it. And I mean, I still came up with the assumption that it's pretty significantly overvalued. The expected returns are basically nothing. But if you look at the forward PE, you can still come up with the idea that a 5-year forward discounted PE ratio is 35. And suddenly it's like, oh, okay, this makes much more sense. So if you want to take all of the growth for the next 5 years into account for many companies, you can look at these PEs instead. And it's already been discounted back at the cost of equity. Same thing with the EV to sales. The current EV to sales for Tesla is, according to my measure, 23, which is a really, really high EV to sales. But 1 year forward, it becomes 16, which is still really, really high, but it's much better. You go 5 years forward and discounting it back, it ends up only 3.66, which means that's actually not bad. That's actually pretty cheap, all considered, right? So the fact that, like, if you look at it, the median and average, it's lower than the median and average. See? So if you're looking at just on an EV to sales basis, you could argue on a multiple basis that Tesla's cheap, assuming that it grows as much as my valuation says they're going to, which my valuation for Tesla, like I said, assumes a pretty high growth rate. So you could argue that that's just too bullish of a valuation, but it's mostly me just trying to be, like I said, reasonable in my discussion with bulls. So you have to kind of take some of their assumptions for granted and then roll with it. In my case, was basically assuming that they become like number 5 to number 7 auto manufacturer in the world within the next 5 years, which is maybe a very bold assumption, but it's not as bullish as some people's assumptions. So yeah, so this is what the forward PE concept does. It basically gives you a way to look at not what their current multiple is, but what their potential future multiple would be, even after discounting it, which brings it more in line with what the present is. It's looking at future numbers, but discounting those future numbers to the present and using that for the multiple, rather than just looking at the future number. So anyway, like I said, I have multiple graphs that kind of help look at things in a nice little way. One of the classic case studies done based off of adjusted kappa measures with factor tilting, which is a complex methodology that's been popularized by Eugene Fama and French. I can't remember what his first name is right now, but Fama and French have a lot of papers on CAPM and adjusting it for factoring, which is basically the conclusions of their study is basically saying that stocks with relatively low multiples, whether that's PE ratios or price to book. I think they were primarily focusing on price to book, but it works relatively well with PE multiples, and relatively small cap stocks typically outperform over the long run. But that's a group of people that do take efficient market hypothesis for granted, and they don't really believe in value investing as a whole. But I still think that the research is very useful, very interesting. So, but either way, the point is this graph right here shows market cap by PE ratio, but we are using the 5-year forward discounted PE. The reason why is because I want to make sure I have all of the stocks within a reasonable range, and not have stocks like Affirm and Tesla with their ridiculously high PEs make the graph skew. And then on the market cap, we're actually using a what's it called, a logarithmic scale, meaning we go up a 10 factor fold at each point here, so that we can look at the mega caps on a similar scale as the small cap. So looking at this, you can kind of get an idea, and according to the methodology of those papers, those efficient market papers, they would argue that basically things that are in this quadrant would be the best buys, because they would be the smallest caps with the smallest PEs, the smallest multiples. So theoretically, this would be the place that you would want to buy stocks that have the best and highest returns. Not necessarily the case, but it does give me an interesting way to look at it. It's just based off that. That's sort of a efficient market way of thinking about it. And then doing the same thing with the EV to sales capital, so it would still be, these stocks would be theoretically cheaper. A lot of the same stocks are in the same areas of the graph, just maybe a little bit tilted and slightly different because different industries have different leverage levels. And so the fact that we're looking at EV to sales discounted back rather than PE discounted back, but we still have a logarithmic market cap on the x-axis. So it's just two interesting market cap based ways of looking at pricing. And then I have two other graphs which are looking at something entirely different, which is the expected COGR total I have over here, as well as the value score that I gave the stock. So the higher the value score, the higher up it is over here, the higher expected return is over here. So I do want high expected returns, but I also want things that have the higher value score. So ideally, you want to have things that are in this quadrant, but if you want to be tilted towards those other factors that I was talking about, the capital efficiency, high margins, excess returns, good ratio between the minimum and highest outcomes relative to the expected outcomes, then you would want to be above the line. That's basically the logic. That the things that are above the line tilt more towards the value scale of metrics that I put into that scoring than they do towards the expected return. So there's more than just a high expected return. This further out on the line is the high expected returns, or further out this way is high expected returns, but you want to have things that are tilted more this way. Like for example, we found the AT&T was kind of that outlier, that it was an undervalued stock that was ranking so far below so many other stocks that weren't undervalued, they were overvalued, and it shows that sort of on this graph how it kind of pokes out a little bit far in this case. So you could argue that things on this side of the line would be better buys in general, especially compared to things over here. Like things over here would definitely be even worse because they have low expected returns, but they also don't even have any of these special factors kind of tilting them a little bit. If you're going to own things that are with low expected returns, then you would ideally want to have things that are on this side of the line, because at least they have a good competitive position, high margins, and good capital efficiency, and things like which, for example, you could see, for example, Google, Apple, and Facebook end up over here. So you could say it's like, oh yeah, well, Apple and Google and Facebook aren't exactly great buys, but they have great margins, they have great capital efficiency, they have great excess returns, and so they end up on this side of Amazon as well. So what you can see is like a perfect way of thinking about it. But obviously, you would want both. So things over here would ideally be the best And then kind of doing the same concept, but not with the value score. We're just looking at just how over or undervalued it is. So it's just value by itself and the expected CAGR. Sort of the same logic here. Ideally, you want something that has high expected returns and is undervalued. And so that would be the things that are, again, above the line, but as far out over here as possible. And then if you're going to have something that has low expected returns, ideally, you would still want it to be undervalued. But you're going to find less of those things. It tends, you can see it's like it almost tilts more like this direction because these things are pretty closely tied together with each other. Between these two graphs, you can see is like a lot of these stocks are relatively in similar locations. There's some shifting, there's some solid shifting where some things do end up in completely different places, but it's a little bit less so. So yeah, there's kind of two ways to take those numbers and kind of compare them, compare where different stocks line up based off of different metrics. Weighting of my portfolio, but whatever. But yeah, so this is my new watch list I came up with. Like I said, pretty pleased with it. I reorder it based off of this value score here. So anytime something shifts in its placing, I move it up a line, move it down a line, and take a look at that. And like I said, I explain how things that are at least one standard deviation up, I consider a sort of a buy. Anything that's maybe 2 standard deviations down out of the stocks that I already own, I consider perhaps to be a sell. It gives me a good way to measure it. It also tells me, based off of this score relative to the other scores, how much of that stock should I be buying relative to others. That's several other things I have here, but a little more complicated. Yeah, so okay, long rant on all that. We finished the evaluation in about an hour, which is what I wanted to do, but then I kind of got to rant for an hour about this new watch list. I'm not telling anybody to go buy the top 10 stocks that come out on this list or anything, but you can definitely do that. I'm definitely not telling anybody to go out and short the lowest 5 or anything, but you could do that. I wouldn't necessarily recommend the shorting especially, but the buying maybe, but that's not a recommendation. Do your own research. Consult your own financial advisor, all that jazz. You know the drill. Anyway, so that's pretty much going to do it for us today. Glad we managed to get through everything that we did. That was pretty much all I really wanted to talk about. I just wanted to quickly go through Skyworks and then kind of explain this new watch list that I come up with. Like I said, it's a little bit of a different time frame. I normally would have done my live stream much earlier in the day, and I also normally would have had one on Friday, and I normally would be doing one in the morning on Wednesday, but I honestly have no idea whether or not I will be doing one. I might do one, I might not. Same thing with Friday, I might do one, I might not. And then next week, I'm definitely not doing any live streams. And hopefully I can go back to doing them the week after that. But the point is, yeah, the next 3 to 4 weeks of my life are going to be pretty chaotic. So who knows when I will be able to do them, which is why I'm just doing one now at this time on this day. So, well, I've got time to do one right now. We'll do one right now. And Skyworks was one that I already had most of the numbers down, so I knew it wouldn't take super long. Yeah, so that's going to be it for today. If you're watching and not already subscribed, please subscribe to the channel. Please like the video, all that. If you already are subscribed to the channel, please like the video. Whether you are or not, please share the video, all of those things. But yeah, I'll catch you all next time.